Albert Einstein once said that compound interest is the world wonder number 8. So in this video, we discuss the magic of compounding. Then we look at 3 examples of how stocks and ETFs grow exponentially. And we explore how fast you could reach 100K. I think you will love it, so let's dive into it. Why is compound interest such an important concept? In simple words, it means you earn interest on your interest. Many people use the example of traditional savings accounts. Let's say you saved 100 euros so far, you put it into a savings account, and you earn 5% interest on it. At the end of year 1, you earn €5 interest, and you have 105 euro in total. At the end of year 2, you earn €5 on your initial deposit, but also 25 cents on the interest from last year. That is the magic of compound interest. Now, 25 cents may not sound much in the beginning, but this grows exponentially over time. You can find all calculators in the description box down below. Are stocks and ETFs also compounding? Because there is no interest in stocks. No pun intended. The short answer is yes. For stocks and ETFs, compound growth applies, not compound interest. So let's look at 3 examples to make it a bit more clear. In example number 1, we have Anna, who has a flower shop in New York. She invests $100 into one ETF, and she plans to hold it for 10 years. Anna doesn't plan to buy or sell any shares, and we assume a 10% return per year. Anna has $100 now. After 1 year, she will have $110. That's a gain of $10 in just 1 year. After 2 years, she will have $121. That's a bigger gain than the year before. After 10 years, Anna will have $259.37 on her account. This is because stocks and ETFs are measured in annual percentage returns. In other words, Anna has returns on her returns, even though she has the same number of shares. There is a useful metric called compound annual growth rate, or in short, CAGR, which reflects this. It measures your investment's average annual growth over a given period, and it shows you the average rate of return per year. In example number 2, we meet Carlos, a small shop owner in San Francisco. He also invests $100 initially, but he chooses a dividend ETF where dividends are reinvested. He holds it for 10 years like Anna, and he receives an annual dividend yield of 5%. Returns of dividend ETFs tend to be a bit lower, so let's say Carlos' expected annual returns are 7%. In all examples, we ignore taxes and inflation, and we set the dividend payout to quarterly. After 10 years, Carlos will have $326.20 on his account. What's the difference to Anna's investment? The accumulating ETF increases 7% in value, but it pays out dividends of 5%, which are reinvested. And as a result, the value of the ETF increases. Here we have the combination of compound growth and compound interest. Let's move on to example number 3. We see Maria, a coffee shop owner in El Paso. She invests $100 into an ETF for 10 years straight. Maria makes 10% annual return per year, but in contrast to Anna and Carlos, she continues to invest $100 every single month. After 10 years, her balance shows a whopping $20,245.76. Why is that? Maria adds fresh capital to the principal amount over and over again, which leads to a bigger compounding effect, even though it's just $100 every month. That's magic, isn't it? Now, how long do you need to reach 100K by investing $100 or euro or pound every single month? By assuming an average annual return of 10%, it will take you 23 years to cross the $100,000 mark, ignoring taxes and inflation, of course. The takeaway is small actions plus consistency plus time equals exponential growth. It's super important to adopt this perspective. Don't be scared of big numbers. Just be consistent and patient. The question is not if you reach 100K. The question is when you reach 100K. Returns may be 7% or 17%. Inflation may rise or fall, or you may pay capital gains tax if you sell shares. This only changes the time period that you need to achieve your goal. I believe that you can reach 100K. What about you? How many years do you think it will take you to get there? Write it down in the comments. And if you enjoyed this video, then give it a thumbs up and subscribe. Thanks a lot and see you in the next video.